Babcock International posted its best underlying numbers in years on June 23rd and became the FTSE 100's worst performer on the same day. Underlying operating profit rose 19% to £433 million. Free cash flow jumped 71% to £262 million, and the board announced a second £200 million buyback. The provisional answer lies not in the headline result, but in a single fixed-price contract. The Type 31 frigate program delivered a £140 million charge that stripped £140 million from reported profit, pushing pre-tax profit down 14% to £283.7 million. That is the bottleneck. Not the business, not the defense market, but one shipbuilding contract whose cost structure is structurally at odds with how Babcock grows everywhere else. The paradox is precise. Nuclear division profit rose 23%. Margins reached 9.5%. Aviation revenue surged 34%. The group's contract backlog stood at £9.8 billion, nearly 2 years of revenue. Hargreaves Lansdown described the results as good progress and noted underlying performance was ahead of expectations. Yet shares fell 6% at the open to 1,077 pence. Dan Coatsworth at AJ Bell noted the market split directly. Existing holders were trimming because no guidance upgrade was offered, while new buyers entered on the pullback believing the results were solid enough to justify entry. Both reads of the same set of numbers playing out simultaneously in the price. That split is not a sentiment quirk. It reflects a genuine disagreement about what Babcock's investment case actually is: a defense thematic compounder with structural nuclear growth, or a company where one fixed-price contract periodically resets the P&L regardless of what the rest of the business delivers.
The Type 31 frigate contract is not a new problem arriving on an otherwise clean ledger. The £140 million charge announced today brings the total charges on this program to approximately £330 million across 3 financial years. The 2023 and 2024 financial years each saw earlier provisions. Today's charge followed a trading update in May 2026 that first flagged higher-than-expected rectification costs from complex late-stage rework on ships 1 and 2, caused by out-of-sequence construction activity and earlier design changes. The audit of the full accounts was delayed until late June, specifically to quantify the revised program estimate, a detail that signals this charge was not a routine year-end adjustment. Jefferies noted the scale surprised investors, precisely because concerns about the program had appeared to ease over the prior 2 years. The buried assumption the defense thematic consensus treats as settled is this: that Babcock's fixed-price naval shipbuilding legacy is now ring-fenced from its high-margin, long-cycle support and nuclear businesses. The Type 31 record disproves it. The contract accounts for less than 4%.
Babcock's nuclear division is the fulcrum. It accounts for nearly 40% of total revenue. It grew profit 23% this year, and it carries margins of 9.5%, already above the group's medium-term target of at least 9%. The UK government's Clyde 2070 program, described in the results as one of the most significant UK government investments over the coming decades, underpins decades of work at HMNB Clyde, where Babcock manages all in-service award for the UK's nuclear submarine fleet. Global nuclear expenditure is projected to reach $2.2 trillion by 2050, and the UK has already allocated £2.5 billion for early small modular reactor deployment. The structural case rests on nuclear, but the single most material near-term variable is the Fleet Marine Support Program contract renewal. The FMSP covers Babcock submarine support operations, the core of its defense nuclear business. CEO David Lockwood confirmed at earnings call that the work will not stop if a new contract is not signed by the current deadline, but that a delay represents a delay in opportunity rather than a direct revenue loss. Harry Holt, who takes over as CEO towards the end of 2026, noted that funding certainty and Pan-Whitehall approval are the outstanding conditions. The transition itself introduces a second variable. Lockwood guided the business through its recovery from the 2020-2021 accounting crisis, and Holt has not yet run the group through a set of full-year results as principal. Around 70% of FY 2027 expected revenue is already under contract, which limits the downside to guidance. But that coverage figure is unchanged from a year ago, which means the organic growth ambition, mid-single-digit revenue increase, and margins rising to at least 9%, depends on winning new work at the margin, not on the existing backlog alone. The question that CH2's analysis leaves open is whether the Type 31 cash costs, which run through the remainder of the contract, will suppress reported cash generation enough to limit the pace of further buybacks.
Babcock shares are up 112% year-to-date entering today's session, the third best performance in the FTSE 100 for 2026. The stock's re-rating has been built on the defense thematic and on the perception that its operational recovery was structurally complete.
Today's 6% open drop is the market marking a distinction the thematic consensus had smoothed over. There is Babcock's structural business, which is genuine and improving, and there is Babcock's fixed-price shipbuilding legacy, which is not yet finished, and whose costs are hard to forecast in advance. The directional leaning, grounded in the pool rather than a single analyst target, tilts cautiously constructive for the medium term. Jefferies and Peel Hunt both maintain their positions, despite the charge, citing beat on revenue, cash flow, and the new buyback as signals of underlying balance sheet confidence. The £200 million buyback, launched after a £200 million program was completed only in April, is a concrete management action, not a forecast, that constrains the bear case. Against this, the main risk the pool records is the absence of a guidance upgrade despite consensus-beating underlying numbers. Russ Mould at AJ Bell stated directly that there is now an element of disappointment among investors who expected the defense spending cycle to deliver an explicit earnings upgrade. For the holder, the monitoring variable is not the underlying profit number. That is already tracking ahead. It is the rate at which Type 31 cash costs are absorbed through FY 2027 relative to free cash flow guidance. If Babcock delivers FY 2027 free cash flow in line with or ahead of the £262 million base established this year, while the FMSP contract is renewed on time, the thesis holds and the share price re-rates further. For the watcher, the entry trigger is not the current pullback. It is the FMSP contract confirmation and the first set of results under Harry Holt, which will establish whether the CEO transition introduces additional guidance conservatism or maintains Lockwood's upward trajectory. A stock up 112% year-to-date with one major contract renewal outstanding and a CEO handover pending is a story to watch, not to chase. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.